Now, this wouldn't be a property show without an opportunity that we present to you. And to paint the picture, I'm joined by Damian Collins, chairman of Westbridge Funds Management. Damian, thanks very much for joining us on the program. First of all, before we talk about the actual fund that you're bringing forth, can we lay the scene, the context in which we find ourselves? So we're now looking potentially at a better rate environment, rate cuts coming. Is that what we're looking at?
Yeah, Tessa, we certainly saw when interest rates were near zero, there was a lot of money going into commercial property and yields went down significantly. Of course, as rates went up, the people could get 4.5%, 5% in banks deposits and even government bonds. The appetite for property income waned. And a lot of people also just parked their money on the sidelines, just waiting to see where the dust settles. But it's fairly clear now that interest rates are certainly heading in the only direction they're heading is down. It's just a matter of when. And so we are starting to see more money start to accumulate on the sidelines and starting to come back in smaller amounts in property. I think it's going to come back in a much bigger wave late 24, early 25. So there are some really good opportunities out there because there's still a lot of money sitting on the sidelines, and there's certainly some great buying.
Yeah, I mean, it is not an exact science to nail the timing, isn't it, in investing? But are you pretty confident that this is the time, as you say, that we were just waiting for the dust to settle? You've seen inflows into the commercial property sector. So you're saying that you're confident enough to say it's a good time to get in right now?
Yeah, certainly. So, look, some assets have had to be re-rated, but mainly in the office space, considering obviously everything working from home. Industrial markets held up pretty well through the whole cycle over the last few years, simply because even though yields have increased a little bit, the rents have increased even more. So industrial assets have held up very well. So certainly, look, yeah, there's no certainties in this world, but the bond market's forecasting 0.6, 0.7%. Drop in interest rates over the next year and a little bit. CBA I saw forecast even higher rate cuts, and I think once people see they're not going to get that 4.5%, 5% in term deposits anymore, they're going to start chasing better yields, and certainly commercial property is going to be one of the main beneficiaries of that switch in market sentiment.
All right. Okay, now let's talk about the fund in particular. It's got quite a catchy name. It's called the Westbridge Total Return Fund. Can you give us an overview of what this fund is and what the assets are?
Yeah, so we set this up some 12, 18 months ago. The feedback from our investors was that they obviously with the bank rates going up, they didn't want to just focus on yield, they wanted to focus on value add. So we set up this fund for investment Australia-wide, and we have assets in 3 states. And what it is looking for ways to value add to the property. So not just rely on the income stream as a way to get the returns. That's obviously critical and important. At the moment, the income returns are about 5.5 to 6% on the assets, but looking ways to value add. So that can be through either refurbishment, a short-term lease. We've got a small shopping centre in Queensland where we had some vacancy risk. We've now just gone into a heads of agreement with the medical centre at quite good terms to get that leased up. So there's a pub in Adelaide that we did some value add and releasing. So it's all about value adding to the asset, not just sitting there and collecting the income. And that's certainly been very popular amongst investors.
Yeah, I'd like to bring up the specific assets a little later on. I just want to go back to the overview of the fund because I see that there's a shorter term time frame for this. Is this something that is in demand at the moment? When you look at the cash tie-in, I suppose, in a fund, is that why this is being offered?
Well, I think with the uncertainty that we had with interest rates going up, there was some people who'd been around. I was around back in that late 80s, early 90s, and relatively young then, but nonetheless I was around. I remember those days, and I think there was a lot of uncertainty about investing in long-term assets and long-term funds. So certainly the shorter-term concept has become certainly more popular, where it's get in, value add to those assets over a couple of years, reposition, do what we need to do, and then get out of those assets and get the money back to investors. So look, everyone's different. There's still some people who just want that long-term hold. Some people want very short development opportunities, get in and get out with 2.5 years. This one was targeted around a 4-year period, and it's certainly, yeah, there's a mixed appetite. Some people certainly looking to get their money back out of investment opportunities sooner rather than holding them for 7 to 10 years.
Yeah, liquidity being a big concern at the moment. All right, I'd like to go through the specific property that we can find assets in this fund. We start with, South Australia. Can you tell us what the value add is in each of these? So you've got South Australia, Queensland, and WA. Okay, let's start with South Australia.
Yeah, so this was a pub that was also had a liquor store attached to it, and it was leased and on a relatively short term. We went in there and were able to do a deal with QVC, which is affiliated with AVC, which is a big private equity owned pub operator. We're able to extend their lease out. We contributed some money to a refurbishment, which is undergoing the way at the moment. There was some vacancy on the side. We extended the lease by 10 years, and estimates are that the value of that's going to be up to some 26% once the refurbishments have come through. So obviously waiting formal valuation when that happens. So yeah, another great opportunity that we got a well-established, well-regarded pub operator, a long-term lease, contributed to a fit out. They're committed to the site, and also they're paying additional rent to compensate us for that contribution. Plus there was there's 5 specialty shops. They've kept 2 to run their pub operations. We've got 3 left, and we're in the process of leasing them up at the moment. So once all that comes to play, we're expecting a pretty significant value uplift. The next one is in Brisbane. This is near in the Trade Coast area. And certainly we expect a significant lease and rent increase because that sector of the market is in such short supply. I mean, industrial properties across Australia are in very short supply, but cold storage is in particular. And so when we did the market analysis on that, we saw that there was only a short period of time before those assets, before the market review came in. So we're certainly expecting a significant increase in market rents once we get to that point, and that'll certainly reset the value. Expect the tenant to stay, of course. If they don't, there's plenty of other tenants in that space who will take up that space at market rates. The third asset on your screen there is also in Queensland. This is a neighbourhood shopping centre. Had some vacancies, it needed a bit of love and care. We've just done a deal to get a medical centre in there, which is great for neighbourhood shopping centres. Brings in traffic. People go to the doctors. They also go to the other specialties in the centre. And there's also potential there. So we've got heads of agreement on that lease. There's also potential there to put in another, with this excess space that we have, which we're looking at the moment, to put in some additional shops as well. So that's something that, depending on the feasibility, may or may not do, but just getting those vacancies taken up means that rental returns and the revaluation of that property is going to be significantly higher also. And we've also just purchased 2 assets recently. They're 2 medical centres. This is the one on the screen is in Joondalup. For those who don't know where that is, that's in the northern suburbs of Perth. When I say northern suburbs, about 20-25k north. That is a day hospital. It's certainly with medical and healthcare is a huge growth industry. We've got the baby boomers all now rolling into that 60+ age bracket, and it's leased to a very well regarded national operator. And again, we expect significant rent increases once the reviews come through. And this is a medical centre down in the south of Western Australia, so Bunbury, about just under 2 hours drive out of Perth. Again, that needs some love and care, and we're also working with that tenant to value add by looking and putting in some more consulting rooms. So all of the assets have a quirk to them. There's some way we can value add, whether it's resetting the market rents at the right time, whether it's refurbishing the properties, whether it's leasing up the vacancies, or simply just contributing to some fit out and renovation costs to get tenants to stay longer. So all of those, I mean, we're targeting in the fund between 10 and 12% total internal rate of return over the time that the fund's in operation over that 4-year cycle.
Yeah, okay, so I can see the, I suppose, the thread that goes through all those different properties that we just saw. So what is your growth strategy? Is that it? Looking for discounted valuation, looking for where you can add value add? You say that it needs a property that needs some love, and that's where you guys come in. Is that the strategy moving forward?
Certainly for this fund, yeah, and we're still looking for other assets at the moment. And we think now is certainly a fantastic time to buy. We bought those two assets, two medical centres just recently from one of the big listed groups. They've got redemption requests, so they're having to get assets out the door at prices they wouldn't like to sell them for, but they've got some redemption requests. So it's been a great opportunity to pick up those assets. And I think we're going to see a re-rating in the market. The cap rates or the yields blew out. Some of those assets that are on screen there, particularly those last two we bought at 6.5% to 7% yields. That's really good considering where the market was, certainly in the fives and even lower in some cases only 2 years ago. So I certainly anticipate once rates, the Reserve Bank rate comes from 4.35, some forecasts are down to 2.85. If that happens, all of a sudden people are getting 3 and a bit percent and maybe in a bank or a government bond. That's certainly not going to be as much as they'd like, and I expect we'll see re-ratings of commercial property, meaning yields come down, meaning capital values go up. So certainly, yeah, right where we sit now, we're very optimistic about the market. Obviously, it's still very sector-driven. Office, we really don't have any of that across our entire. We've got nearly $1 billion of assets across our entire group. We only have 3% in office. We've kept away from that. The time will come for office, but we're still very focused on medical centres, neighbourhood shopping centre, not the big shopping malls, the local service centres, and industrial property. We still think those sectors have got the best opportunities in the next 3 to 4 years.
Yeah, Damian, before I let you go, I do want to ask about risks. So we've talked about why these seem like good opportunities, but what risks have you factored in? There might be the possibility of perhaps a protracted high rate environment or a belt tightening in the economy, regardless of whether you're in a defensive sector or not. So what are the risks that you have factored in to this fund and that investors should look out for?
Oh, look, there's always risk. You don't, if you want no risk or very low risk, you go into a government bond and get your 4.5%. That's the reality of the world. There's always risk, but our strategy as a fund manager is certainly to mitigate those risks. We obviously do a lot of interest rate forecasting. In this fund, we haven't as yet hedged any of the debt because the cost of hedging at the moment is still too high relative to where we think the returns are going to go. But the other good thing is, in commercial property, a number of the leases are CPI linked anyway. And so what you do find is if CPI stays higher for longer than you anticipate, that tends then to flow through to your rental income stream as well. And a lot of the leases, of course, also have market reviews, and the market reviews have been very, very strong in industrial and certainly across our portfolio and even in this fund, there's as industrial property as part of the mix as well. So certainly, look, there's always risk, but we're there as a fund manager to try and mitigate that through, we do a lot of modelling and interest rate analysis on whether or not to hedge, certainly getting the good quality tenants in and making sure they're on long-term leases with good reviews. And they're just a couple of the things that we do as a fund manager to try and mitigate risk, but of course all investments do carry risk.
All right, thank you so much. Damian Collins, a lot of information there. Westbridge Funds talking to us about the Total Return Fund. Thanks.
Thank you.